It's actually 35 years journey, and I have to tell you in 35 minutes. So probably I'll take some more time because today we are early for dinner. So I'll take a little more time if it with your permission. But actually, when I look back, I mean everything looks to be unbelievably real, as if I am seeing what has happened few months back or few years back, because I have lived it so passionately and almost like every day that the journey which has started. First time I bought a stocks in 1980. I was in a hostel and I had very small amount of money. My brother actually wanted his money to be invested in stock market. In 1980, the markets were actually very primitive. I mean, when I look back, how much anything can change in 30 years. I think nothing has changed more than probably the stock markets. Worldwide has changed, but I think maximum change is visible in India, in the sense that there must be some people who must have been buying in 1980 also. It was you used to get broken certificates. The tape used to be in ACC certificate. You'll get 1 share, 2 shares, 4 shares, and a full bundle used to come. Almost truckloads used to come. So it was a crazy kind of a primitive market. It used to be market for 2 hours. Settlement used to be T plus 15. If you're lucky, it used to be T plus 15. Mostly it used to be T plus 21 or almost a month also. There used to be pain crisis, in the sense that, shares have been taken by the brokers and there is no payment coming from them. Can you believe it today? That hundreds and thousands of crores of shares, by way of pain, you got the shares and you are not given the check. And nobody has any control over you. It was completely in the faith that the system worked, that the culture of BSE and stock market and all. So, today the institutions are not out of pocket even for a minute, in the sense that give it today and take it today only. So there is absolutely no gap. There is a guarantee. Even while this exchange is happening, there is a guarantee of the institution. So there is a trade guarantee fund, there is a trade guarantee by the exchange. So clearly it's a very different market. In 1980, it used to be very, very physical market. And then slowly we started moving to, there were no professionals. By the time I became chartered accountant in 83, and when I came to the market, again that thing that there was not much of books, no cable TV, no newspapers. Newspapers were there except for business. They used to write everything else. So there was nothing much to read. So I was reading balance sheets. I would go to anybody's house. I'll come to your house if you had 5, 10. In fact, I made a lot of friends because they had shares of the companies, so that I could get balance sheets free of cost from them. So because companies were not sending you balance sheet, you couldn't request the company and they'll send you balance sheet. It was so bad in 80s. So you had to collect balance sheets only from the guys who had the shares. So I used to go collect the balance sheets and go into home and read it. So that became a huge strength for me. But the whole thing was so primitive that you didn't know anything other than EPS and PE. Just 2 numbers, EPS, PE. Even growth number was not understood. If EPS was to go up, they will call it change in PE. And if EPS, PE is to go up, then change in PE. So, the whole thing was very, very simple. Today it has become far more complex. You are looking at return on equity, you are looking at growth, you are looking at 5 years growth, you are looking at compounded machine. I'll tell you about compounding. I understood about compounding in 1991. I knew as a concept as a mathematics student, but I didn't know stock market is nothing but compounded machine. That came to my head only in 1991. So I'll tell you, a little later. Then we did research and we said, let's start business. So 1987, I found partner in my own hostel, that is Motilal Oswal, and he was looking for this thing, what is that? In Lokhandwala complex, you couldn't get auto rickshaw. So anybody who had bike, you are willing to give him support. And here is Motilal, who didn't have that bike. I had the bike, so he used to take lift, and he is so good. After next day, after first day, he started coming to my house, and he's so restless that he would not wait for the thing on the road, and he will come to me and pick me up, and then we go. So like that, we started developing relationship. And so I knew everything about the market. And I was research associate and reading everything, all the balance sheets and all. So I had a lot of confidence, but I didn't have money, I didn't have any clients. So there was no business. Here Motilal comes, he wants a broker. He has all the, like he had trades coming from Ahmedabad and Madras, but he didn't have a proper broker. He was cheated by 2-3 brokers, and he was in lookout for a good broker. I said, this guy makes as a good partner. He's a chartered accountant, he has an office, he has clients. I don't have anything, so let's come together. You know, so that's how we formed a partnership. And he was very hardworking. I was trying to put my best. I was not good in time management, but still okay. So, you know, kind of we started this partnership, a small partnership. And then till about 4-5 years, it was very bad. I mean, it was a bear market. You cannot imagine how bad it was. Like it used to cost us about $35-40 to reach from office Kalwa Devi to Bombay Stock Exchange. There were days when we didn't earn 35 rupees brokerage also. It was so bad. You had to drink 2-3 cups of coffee to remain awake during those 2 hours. Market used to be very dull. And the bear operators were really running the roost in the sense that they will, whatever you're buying, they will go and hammer it in the market. You feel absolutely unnerved, a small kid in the block, and you know, somebody, big operator is hammering it. They will sell Reliance, they will sell HLL, anything, whatever comes on the way, they will sell. And they will have, because they were getting the difference also. So the trade was going on their favor. But we didn't understand A group, we didn't speculate anything, we didn't get the client to speculate. So we were kind of keeping ourselves clean of speculation. That really served us very well. We never speculated. We never borrowed. We said, boss, we want to make this little money of 300-400 rupees, 500 rupees brokerage, and I'll be very happy. That's how we, till about 1990, things were very bad. Then suddenly the life changed. Harshad Mehta bull run started. There used to be a header in Money and Profit and all those kind of magazines. Will BSE ever cross 1,000? You know, it used to be at 700-800. When it were attempting to cross 1,000, you can still go and find those headlines. Will BSE ever cross 1,000? That used to be the headline. So, I mean, people are just not expecting that anything can happen. Like today, in the world economy, it is felt as if world has ended and America can never revive, Europe can never revive. We are all going to die as it is where it is. That's the belief right now. That's why zero interest rate, negative interest rate. So much of pessimism there all over the world. These are all temporary. Nothing is going to last. You see a bull run, I mean, global economy bull run, you cannot believe what is going to happen. Just give it long enough time. These are all cycles. These are all cycles. So that time, that was the kind of thing. Then Harshad Mehta bull run started. I don't know from where money came, and the size, I used to accept the order and Moti used to execute. The size of the orders went 100x. The guy who used to buy 100 shares, they will buy 10,000 shares. And more than that, the price of the shares, which used to be $10-20, that became 100 rupees, 200 rupees. So single orders, they suddenly started becoming, in fact, I had preserved the order book for some time, for 4 years. How can it happen like this? The junk companies were the most expensive. I mean, 5-6 rupees companies were trading for 500 rupees, 700 rupees, and millions of shares were trading hands. And trades were getting honored. So we were making a lot of brokerage. So by the time it was 1993, 1992, when it collapsed, we had 30 crores worth of shares with us. From a 10-12 lakhs rupees guy in 1990, we had become so much bigger. You know, so that nobody could throw us out from the market. Because when you are small, anybody can bully you around you, some bad delivery here and there, you can be thrown out. But with this 30 crores in hand, nobody could then, in fact, we were respected even when we were sub-brokers. Sundar Iyer was our main broker. And even within Sundar Iyer, we were the most respected sub-broker. And the market used to know, whenever Moti used to go and buy anything in the counter, in Chennai they used to say, Raamdeo is buying, you know. So that used to be there in the ring. And in 1992, after that, the thing collapsed, then the professionals started coming in. The market started getting professionalized, and Manmohan Singh was the finance minister. He said, all the brokers, please come and register with SEBI. SEBI came into being, and the brokers protested, and hence the NSE was given birth to. And in 1994, the brand new exchange came, National Stock Exchange. And Anybody could walk in and become member. So we also became member day one. And, but this particular thing, the index going from 800 to 4200 in just 2.5 years in 92 was a complete game changer for us. In fact, I would think that Motilal Oswal took a birth in 1990 because of this bull run. Otherwise, the birth would have become more painful and much more prolonged. And I don't know what shape it would have been. But for every business, I have a deep impact of this particular phenomenon. And I sincerely believe that for any business to take a birth, successful birth, you need a tailwind. Tailwind. You know, you need external help. If you keep trying very hard, but if the external environment is not helpful, you can do very little. This is the current plight of this economy. Modi Sahib is trying very hard, and he will try even harder. But the real boom will come when the global economy moves. Because 50% of the economy is externally aligned. Today we are more global than China. You see today's mint. We have 53% of our total trade, export and import is 53% of GDP. So if 53% of GDP is dependent on global trade, unless that global economy moves, you will not have that impact. You need that support from outside. Yes, you can do internally, you can do 6, 7%, 8%. But if you want to go to 10, 12%, I am quite sure it is not going to happen unless there is a global support. And it will come. It will happen. Because it has been happening for last 30, 40, 50, 100 years. It will happen in next 4, 5 years. It may get delayed a little bit. But it will happen. So you need that tailwind for anything to take a successful birth. And after that, then success breeds success. You know? So that was the big game changer. Then around 93, 94, we used to think that we are very smart in the stock market, we read everything, we can do research and all. But when I first time heard about Buffett and read his first annual report, then I realized, boss, you don't know anything about investing. The one sentence he said in, I think, 94 annual report, if you go and see, the old man is also evolving. He started in 1950, but in next 40 years, every year he's becoming wiser. So in 1994 report, he is saying, don't focus on EPS, focus on return on equity. You know, and that kind of changed me completely. So then we started saying, this guy knows something much more than us. And he can, obviously he knows 1,000 times more than me. Then we started reading from 1967, all the letters I read till about 1995. It took 6 months to 8 months, but then I became a complete convert for him and I went to Omaha to see his next year's lecture. One of the friends, Sanjay Bhattacharya, and his friend, Sunil Mehtani, he took us to Omaha. And there, this particular photograph is actually, I was getting, that time it was not that big an affair. It was 3,000-4,000 people used to be there. Charlie Munger would be roaming around with you. Nobody would even bother about who is this guy. Even Buffett would come onto the crowd and shake hands with the people whom he used to know. And he would, one day before in the evening, he would actually sit, which is what we are doing, under a lamp post, and there you can go and give your dollar bill or a book and get it signed. You know, he will give a photo shoot. This is what he's doing, and he's signing a dollar bill for me. So this used to be the thing. There would be hardly 100 and 200 guys. Today, this year, my sense is that in Omaha, there will be 60-70,000 people. Last year it was, I think, 43,000. This year, I would be surprised if it is anything less than 70-80,000. Anybody I know, they are going there. From Mumbai itself, I know it used to be 5-6 guys. Now, this year itself, it is 10x. 50 to 60 people are going from Mumbai, if not more. So many people are going. I don't know how Omaha is going to accommodate and how it is going to look. So this is the biggest event this year. But when we went first time in 94, it was quite an isolated event. Even Americans, they were not going there. They could fly in 2 hours, but it was just not that much of a event for them. But he basically described what is the difference between book value and intrinsic value. Price is what you pay, and value is what you get. But value is not, price of everything. I mean, at the closing of 3:30, you get price of all the stocks, but nowhere you get a quotation for value, underlying value. What is the underlying value? That what is quoted 100 it could be worth 1,000 and it could be worth only 10 rupees. Because this is one market where 1 rupee stuff can be sold for 10 and 10 rupee thing you can buy it for 1. This is a crazy market. So everybody knows the price, very few know the value. The guys who understand the underlying value, they win the game, fundamentally. Come in the front. There are quite a few seats here. So fundamentally, the difference between book value and intrinsic value is the key game. And I think the starting point was the Buffett's letters. And one of the, as I said, Sanjay was the guy who kind of helped us. First, he introduced the Buffett letters to me, and he helped me even go to US. Then on the way, then explosion of all the books happened. When there were books and books, Buffett was I think there was 30, 40 books on him, and we read a lot of books because availability of books became very good. So one of the most classic book, which everybody should read if one is interested in the stock market, is Common Stocks and Uncommon Profits by Phil Fisher. So this is that scuttlebutt thing, and how do you look at stocks? What are the characteristics you look at the stock? Is the ultimate growth /value investor from Buffett's two gurus. One is Benjamin Graham and second is probably Phil Fisher. So he borrowed some traits from Phil Fisher and some traits from Benjamin Graham. More from Benjamin Graham and less from Phil Fisher. But this book is another classic to where we learn. Then Competitive Strategy by Michael Porter. After Buffett, if there is one guy who helps you in analysis, is the 5 Forces of Michael Porter. Then you have Berkshire Letters. Then I think one of the book which is not that famous and which is creating huge wealth today, Value Migration. Value Migration by Adrian Slowetsky. This book is a seminal book on how values move from one business to other business, from one country to other, and how better business models, they win over a period of time. And so you have to keep looking in the portfolios whether you have the best business model today in particular business. And then, Professor Greenwald, he wrote the Value Investing, where actually maths of Buffettology is given there. And then Professor Michael Mauboussin, he wrote Expectations Investing. So these books went long way in framing the thought process about investing. 1996, we became corporate. I don't know whether you're aware of it. Till about 1996, you couldn't be a partner in a stockbroking firm if you are not a blood relative of the person who is a member. So I was not blood relative of Motilal, so I couldn't have been a partner to the firm, though we were working equally. So I was a consultant till 1996, and then we formalized the partnership. And when we made it, Motilal Oswal Securities Limited. That was 1996, and to commemorate that particular event, we started wealth creation studies. So the idea was to to figure out how wealth is created in last 5 years, because as Phil Fisher says, come in the front. Yeah. So, Phil Fisher says, it seems logical that even before thinking of buying any common stock in any country, the first step is to see how money has been most successfully made in the past. Because every country has a different set of companies, different set of businesses which are relevant at that point of time. A hair oil company, I think there would be hardly any country in the world where a pure coconut oil company can be a wealth creator. Just pure, simple coconut oil company. He says that it's a pure coconut oil, there is nothing added. We don't even excise, it's an agricultural product. And yet it makes so much of money. So, every country has its own traits. I think India is the only place where people put so much of oil in their hair, as a hair care product. this is the probably only country where two-wheelers make money, in the sense that, of course, Japan made money, but now Japanese two-wheelers are not making money. But this is the one, in China, the industry size is multiple times bigger, 5-6 times bigger. But none of the two-wheeler companies make money in China because they are very small, very low quality. Some of they are not, they don't sell brands and all. So you go to the country and there you figure out which one is going to make money, you know. So with that purpose, we started this wealth creation study. And the very first one we did was the very first study was based on return on equity and the importance of return on equity. It was very primitive in terms of, because the learnings were so much and we knew so little. See, what happens is investing, what you need is the frameworks. So how to look at particular thing, how to look at interest rates, how to look at the earnings growth, how to look at the quality, how to look at business, how to look at management. So like this, there are hundreds of questions. So you might be, see, in chartered accountancy, I might have learned 25 of them. When I read the books, I might have read another 25. So I might be having arsenal of 50 frameworks. Buffett might be 150 frameworks. And 150 frameworks is not 3 times of 50. They are like infinite times of 50. Because every framework adds massive power to your analytical capability. You know? So the whole idea of wealth creation study is to keep collecting newer frameworks. So in one of the studies, somewhere in 98, 99, we talked about mathematics of Buffettology. So in Buffettology, Mr. Buffett, he tries to see the 3 buckets of value. In any company, there are 3 buckets of value. There is a breakup value, there is a franchise value, and there is a growth value. And you have to be very clear. So breakup value becomes very small the moment company starts becoming very profitable. So in franchise value, the quality starts coming in. That's why we call it Q. So the franchise value is very large in good companies and the breakup value is very small. If you look at Colgate or Lever, the book value will be maybe 10 rupees, 12 rupees, 15 rupees. Whereas the price of the stock will be 200, 300, 400 or maybe even 1000. So book value will be very, very small portion. They are being valued very high because their return on equity is running into 100%, 200%, literally infinite. They don't use any of the capital to make money. That's the highest order of business. When you don't use capital to make money. So that's a franchise value. Then these companies are very expensive because they are very profitable. But we still want to make money. So that you make money purely because of the growth value. So this fantastic franchise, if Colgate is making, say, 500 crores, and return on equity is, say, even 100%, year after year. But if it remains at 500, and you pay, say, 40p or 50p, you will not make money, even if it is Colgate. That 500 crores earnings must grow at 10-15%. Then you will make, 15 plus maybe 5-6% yield. That will make you about 20% kind of a return. So you need franchise value. See, if you have only breakup value, if the assets are available because they are loss making or they are very bad, if the breakup value, if book value is 20 rupees and you are getting for 20 rupees or even 15 rupees, they are very expensive. They are very expensive unless there is a earnings power, because market loves earnings power. And if there is no earnings power, assets are lying, I don't think anybody cares about it. Only in the peak hours, in the bull run, when market becomes irrational, then these dead assets, they become expensive. But typically, the only breakup value companies where there is no earnings power, they will not be valuable. So you need breakup value, you need franchise value, and you need growth value. And that mathematics is one of the studies where we clearly wrote. And this book is one of the seminal book on Buffettology. Then at the turn of the century, sometime in 2001, Buffett wrote an article in Fortune magazine where he said, at all times, in all markets, in all parts of the world, the tiniest change in the interest rate changes the value of every financial asset. And this quote is more relevant today than ever. Today, there is no interest rates in 2/3 of the world or 3/4 of the world. The world which really matters, America, your Europe, Japan, even China is heading towards that. So much of deflation is there. People are issuing 10-year paper at 0 or negative interest rates. A lot of high-end corporates like Nestle, they're able to issue bonds, fairly long-term bonds at 0 or probably negative interest rates. They're trading at those rates. So this is very unprecedented times. So what should be the value of financial assets? Actually technically speaking, you can be 30p, 40p, 50p if the interest rate is permanently done. But the world knows that it is not going to be permanently zero. Maybe it is 1 year, 2 year, 3 year, 4 years. Someday, investor sentiment will rise and global consumers will assert themselves and inflation will come back. But this study we did in 2002, when the interest rate for the first time in India had crashed from 11-12% to about 5%. And that time, all the banks were available at fraction of the prices. That time we started buying all the PSU banks. In 2002, SBI was available for about 200 rupees. And the total market cap was about 10 or 12,000 crores for the SBI. And the bond gains, because of the change in the interest rate, was running into 15 to 20,000 crores. And the bond gain was 15 to 20,000 crores, and the entire SBI on top of it, and you could buy the entire company for 10,000 crores. That was the kind of possibility it was there. So when you learn these kind of things, you can see a lot of values. Then we were doing other studies. Then we did another study on terms of trade. One of the things was that you need to buy the companies or businesses in your portfolios which are in seller's market. They sell on their terms. In businesses either you are on seller's market or in buyer's market, where the consumers, either the company has a say on you or you have a say on the company. You get discounts, you go to any other shopping mall. The guy is willing to give you anything for you buying 10, 20,000. By the time you buy, he will give you this benefit, that benefit, because they are not in the seller's market, they are in buyer's market. When the terms of trade changes, what happens is there is no working capital. There are three types of payment mechanism. You buy something, you pay then and there. Typically in retail, that's what really happens. But in the realm of businesses, you have many times you get 60, 70 days to pay for your purchase. Then there is an advance payment, prepayments also there. So what is the terms of trade in a business? At times it is because of the culture, but at times it is about the strength of the businesses. So we did this study. The businesses where profitability is high and terms of trade is favorable, you end up making tons of money. Look at Hero Honda. In 1996, when we bought the product, when we bought the company, at that point of time, there was acute shortage of motorcycles. There was a premium of 3,000, 3,500 rupees for you to buy on spot. Otherwise, you have to wait for 15 days, a month or whatever. So the terms of trade was seller's market. They could get away with anything. Today, if you want to buy a bike, you know what happens? They give you loan, they give you discount. If you ask for one, they'll give you tens of motorcycle. So the whole term has changed. You have to look at the terms of trade today. Between even within the two-wheeler segment, Eicher has a different terms of trade than Hero Honda. In Eicher, you can't get the terms today as you can get in Hero. So terms of trade for Eicher today is very different. You have a 3 months to 6 months waiting list. Whereas in Hero, you have a 3 months inventory lying in their godowns. So that's the basic difference. So you have to look at the businesses which have terms of trade in your favor at the time of purchase. Then I think one of the best studies, then the studies started becoming better. We started learning how to do it, and then we did, till about 2007, we're doing the side part of it, the specialist part of it used to be very small. From 2007 onwards, the thing started taking a very serious shape. So we did one study called India, the Next Trillion Dollar Opportunity. In 2007, what happened was that the Indian GDP was at about 45 lakh crores. And the rupee dollar parity came down from 45 to 42. So suddenly we got into $1 trillion club for that particular year. Then we said, let's study this particular phenomenon and what is the significance of this. because we were about 12th or 13th economy to enter a $1 trillion club. And what is the experience of China? China became a $1 trillion in 1998. Nobody knew what China is. Today, everywhere it is China. And that is what exactly is the opportunity for India. What happens is that when you grow to $1,000 per capita, your discretionary spend is very thin. But when you go from 1,000 to 2,000, your discretionary spend go almost 10x. So what is a linear GDP growth is an exponential business opportunity. So you have to position your portfolio into the companies where this exponential growth is going to happen, because market is not pricing it. So that was the one of the, I think I would think in top 2-3 wealth creation studies out of 19, it is one of the best and relevant even today. As relevant, probably more relevant today, because at that point of time market was at a high. 2007-8 market was running high. I was thinking market is able to see this next trillion opportunity, but it was actually a Lehman credit bubble and it got burst. But the fact remains that we are looking at next trillion, third trillion will come by 2017 or 18 or maybe 19 in just 5 years. The last one came in 6 years. So we are at the cusp of a massive discretionary spend boom. And that's why all the stocks which are going to cater to the discretionary spend in India and has a monopolistic position, they are very, very expensive. They're almost double of what should be the normal P multiple. If it should be 30 P multiple, they're at 55, 60, 65. Because they're expecting this bull run to happen in discretionary spend. Then the next study we did was, again in 2008, Buffett wrote, what are the 3 types of businesses? I think this is the best piece written by him in annual reports. In 2007 annual reports, page 6 and 7, if you go, he has written what kind of companies he likes and what are the traits he looks for in those companies. And he termed it, there are only 3 types of businesses in the world: great, good, gruesome. And these are like 3 savings bank account. Savings bank account where you put your money at a high yield, say 20% interest somebody is giving. So that's a very good return. If you are getting your business earning 20%, it's very good. So that's a good company. It's not a great company. Great company is a company where you put 100 rupees, he gives you 20%, first year, second year it gives 25%, third year gives 35%, then 40%, then 50%, 100%, 150%. You look at Nestle. Nestle in 2001-2, it used to earn about 25% return on equity. By the time it was 2011, it was 135%. You go and see how it has improved year after year. That's what makes Nestle a special company. So, rising ROE. So, great and good was very clearly understood. What is a gruesome? The real challenge for the investor in the market is to throw out gruesome businesses. Now, what is gruesome? A bad business. A bad business is a business which actually breaks the capital. If the cost of capital is 10%, it earns 5-6%, or actually it incurs loss. But even that is not a problem, because it could be just a historical thing. It could be misfortune of the business that it is not doing well. But the problem is the management is mandated to grow the business, which is very bad business. So what happens is you are earning 100 crores by deploying, say, 2,000 crores. Now you want to double the profit from 100 crores to 200 crores. What do you need? Another 2,000 crores. To earn 100 crores, you need 2,000 crores more. So it becomes a bottomless pit of capital. And everybody gets sucked in, because these companies are available very cheap. And most of the retail guys, they get sucked into buying these stocks. And they stay on, because they are not making losses. Return on equity is very low. Valuation is very cheap. What more you want? You're buying cheap. You can't go wrong. But it doesn't make money, because the company itself is not making money. One other thing is, I don't know if anybody knows how much money you make in the market. From a stock, how much money you make finally? You make as much as the company makes. Please understand this. If company is not listed, you start with a crore rupees company and you make 1,000 crores over a period of time. At the end of it, you'll get 1,000 crores, period. So you cannot make more money than what the company makes. People think that they can make more money than what the company makes. And that's why they don't bother about what the company is doing, they bother about what's happening in the stock market. So fundamentally we have to understand, we have to buy great businesses who are going to make a lot of money, not only now, in next 10 years, 20 years, 30 years, 40 years. And that's what we do. And that's what has, this particular study, if you see, we gave an example of Nestle as the great company, HDFC Bank as a good bank, good company, and I hope there is nobody from Tata's, Tata Tele Maharashtra Limited as the bad company. When I wrote as a bad company, Tata Tele Maharashtra Limited, it was making losses of 60 crores per quarter. Do you know how much losses they are making now after 7-8 years? They are making very faithfully, every quarter they make a loss of 165 crores per quarter. They have lost about 12, 13, 14,000 crores. They are still losing. And now they want to expand. They want to put another 10, 20,000 crores to expand the losses. And we still have a quotation of 7, 10, 12 rupees because it is called Tata Tele. You can't go wrong buying telecom company from Tata's, isn't it? So you have to be very clear who is going to make money. Just the name doesn't matter. So difference between, in fact, you should pay to the manager for just getting you into the good companies, good and great companies, and keeping you out from the bad company. 99% of the problem in the stock market is because of the bad companies in your portfolio. And they enter your portfolio purely because they are cheap. And then they come and stay permanently and destroy your entire happiness. Then we did the study on dividends. So stock is worth only what you can get out of it. See, don't look at you bought it for 6 months, 1 year, or 3 years, or 4 years. But if you look at the entire journey of the stock, from the birth to the end, actually what you just get the dividend, nothing else. Rest all is buying, selling. And as a minority shareholder, one guy is buying with other, and that keeps going on. But eventually, as a unit, you get only the dividend. Even the owner gets only dividend in the life of the company. So it is said, a cow for her milk, a hen for her eggs, and a stock by heck for her dividends. So dividend is a very core. And this government doesn't understand. I have been going to SEBI, I have been trying to impress upon the government that, boss, don't charge 20% dividend distribution tax. You're killing the cow. You are discouraging the management from declaring the dividends. If you discourage the management to declare the dividends, the value of the company is going to go down. Because by not declaring the dividend, he is going to put in some liquid funds or going to buy something in Chorus, something in Zen. Somewhere they'll do some crazy allocations. If that same money comes to you, you will go and buy some wonderful company. You'll have holidays. And actually, the valuation of the company will be double or triple. Like Infosys, if they are paying out 40% and sitting on to 30,000 crores, if they pay out 80% without impacting the growth of the company, do you think value of the company will be same? It will be more than double. And if Infosys valuation is more than double, the valuation of TCS, Wipro, everything will also go double. Because if Infosys is available at 15p or 20p, you cannot sell Wipro at 30p. No way. There is an anchoring effect. And then if all these big companies are available at 15, 17p multiple, the whole market settles at lower level. So you need the dividend to be very, very powerful. And it is very tough to make these guys understand what it means. But if you go in any annual general meeting, you get, those small shareholders, they are so smart. They ask for only dividends and bonus, nothing else. They don't ask for anything. So dividend is important. If you read this particular paper, you'll realize we have given mathematics of how dividends decide the valuation of the companies. Then we did the study on moat investing, actually more to do with the unique companies. How exactly the companies become unique and the valuations, they go much higher, significantly higher for the unique companies because the moats are there and those companies become inevitable. Then 2 years back, we, in the same moats and abnormal profits, what are the sources of abnormal profits? Because what you're looking for, if the amount of money you're going to make in the market is dependent on how much money the company is going to make, then we have to figure out what are the factors which lead to abnormal profit for the companies. Some guys make a lot of money, some guys don't make money at all. Why is it so? I mean, everybody is working hard. All the textile companies, they are working very hard, and yet they incur losses. And then you look at the tech companies, they have wonderful campuses, and they barely work for 8-9 hours, and they make thousands of crores. How is it possible? So how do you identify these kind of companies? Because uncommon profits means abnormal profits in companies is equal to abnormal wealth creation in the stock market. So what are the factors? How do you pick up? So this particular process is understood in this particular study, which is, I think, one of the fabulous studies to pick up companies early in the game. If you want to pick up, because what happens is every company takes 8-10 years before they understand the game, and they establish their products, they have enough customers, and they start growing in the marketplace. It takes 7-8 years, 10 years, most of the time. So when they come out from there and they start making money, at that time nobody knows the story. So how do you pick them young at that point of time? That's the emergency story. So the traits are given there. You can wire it up and figure out. We do every quarter. All the companies which are coming out in that particular category is being faithfully reported on the table, and then our analysts go and check up whether there is any probability of these companies becoming big. Every quarter it happens. So these frameworks help in terms of investment management. Then the last one we did was 100x, the multi-baggers. How many companies and what it took for them to create wealth of more than 100 times in last 20 years. So Infosys did about 5,000 times. Lupin did about 2,000 times in the last 20 years. Asian Paints maybe 106, 110 times. So all the companies, so what it takes to make big wealth. And here, this guy is saying, you need only 3 things. To make big money in the market, you need 3 things. Vision to see them. Because in stock market, what are you doing? You're buying the future. You're not buying the past. It's all about future. You pay 5 lakh crores market cap for a TCS, which makes 20,000 crores. So obviously you're not buying the past or present. You're buying the future. You expect this company to make more than 5 lakh crores in next 5, 7, 10 years. Am I correct? So, you need that vision to say at current price what I am buying, this company is going to make multiple times of this. So in 2003, I was using this particular ratio, and Bharti Telecom was just about broken even, January 2003. And I calculated that in next 5 years, this company is going to make about 28,000 crores profit. And the stock was held for 5,000 crores. The company made 32,000 crores profit. So, you are buying the future. Very rarely you get this opportunity that you can buy what a company is going to make in next 5 years. Say it is going to make 1,000 crores. You can't buy it for 200, 300 crores. But this is the market where you get this. And these ideas, they come once in 6 months, 1 year, 2 years. And when you get them, you must pile on. So, vision to see them, courage to buy them. Should have courage to buy when you see this. Because it's all in the head. It is not written anywhere that this company is going to make this much money. And no analyst will write, mind you. All these highly paid analysts, they are not going to write this. Forget it. You have to do it yourself. So you are very lonely in the market at that point of time. In fact, you call up your friend whom you consider as knowledgeate, and he will say you are wasting your time. So literally, your analyst, your friends, nobody will support you. And when nobody supports you, then you should be very sure that you're on the right track. I've gone in 35 years so many times like this. You know, once when I was buying Indian hotel at 110 rupees, 10 rupees share I'm talking about, which went to become 1000 rupees, 1200 rupees, whatever. So he said, Raamdeo, you must be out of your head to even think about this company. I said, because it requires so much of capital, this, that. I said, very good. I had by that time, actually before asking this, I had already bought more than 1 lakh share. Then I said, Moti, please sell this because our friend is not agreeing with this. So there is something wrong, we are making some money, let's get out. I put the order at 10:20, by 10:23, the whole thing was taken away. And we came to know that it was bought by Franklin Templeton. And they made all the money. So, you know, whenever you are early in the game, nobody will support you. You have to be convinced about your own thought process. And all these theories, they help you in holding out to the big one. Vision to see them, courage to buy them, and patience to hold them. And the third trait is the most difficult. And the book says that it is rare amongst the men. Sometimes it is found among the women. But there is no women fund manager. You meet only the guys out here. So, you know, patience is very difficult. If you want to do 5,000 times in Infosys, you had to be sitting through 20 years with Infosys. Then only you can make 5,000 times. And there are guys who are there with the 5,000. I think driver of Nayan Murthy, he is still holding out. So he is the one guy who is the smartest. So, you know, it is not the amount of money you have put in the market. It is the amount of time you have spent on the stock. Because power of compounding can work only over a period of time. So, as these stories were on in last 20 years, you know, somewhere when we did, this study, I think it was just 2 years before that I wrote that now it looks that we have some kind of a process, what works. Because for 20 years we are searching that what is, because if there are a million guys in the market, there are a million ways of making money. And we said, this is our way of making money. So we wrote QGLP as our process. And then we started examining ourselves critically whether we are on the right track. And in the last 2-3 years, we have realized that it is not the QGLP that is important, it is how much intensity you bring in practicing QGLP. So QGLP will remain QGLP, but what will go behind understanding quality of business, quality of management, growth, longevity of growth and quality, and what price you pay finally. So this mix of 4 things, there is no 6th parameter in investing. Good business, good management, growth, longevity of the franchise, and all this at what price you are buying. So you have to interplay of all these 5 variables. You have to arrive at and put in the portfolio. So this was the 20-30 years of committing a lot of mistakes on the way, lots of mistakes, and then learning that this is the right way. So we have arrived at this particular thing, and we have practiced in our portfolios. So for last 12 years, we have been managing value strategy that is a flagship PMS portfolio. The strategy has driven almost 20 times, 19.5 times in last 20 years, with almost 27-28% compounded return after fees, against the index of about 19% or something. So 8 times for the index, which itself is fantastic. And 19-20x for the strategy. The same thing more recently, in last 1 year, more rigorously has been applied in our mutual fund products, F25, 30, 35. So 35 is 1 year old now, and it has given us about 65, 70% return. See what happens. You see the blue and red. You start just 12 months back, slowly it starts diverging. The quality QGL stocks, they start building up month by month, week by week. So it's good for short term, it's good for mid term, it's good for long term. I hope this journey continues like this for all of the investors in these portfolios. And wealth creation studies and the journey will never complete. As it is said, the woods are lovely, dark and deep. This is for the retirement. But I have promised to keep, that we'll keep performing, and miles to go before we sleep. So I think this journey will continue of QGLP and practicing and bringing more rigor. And will be great if all the clients and all the friends, they join in this journey, not only in terms of investing, but also in terms of contributing what are the better ideas, I mean, from the portfolios, and suggesting that they know that this company is better and align in the journey. So that will be very good, and we are all together. All the money is, whatever I have earned or whatever company has earned is also in the same strategies. There is nothing beyond house, not in this portfolio. We don't buy any individual stocks now. We buy only our own products. So alignment is total. So the journey is now, the clients and us, we are in the same boat. If anything happens, either way, we are all together. So thank you very much for patient listening. And, I hope so we'll take few questions. Please avoid specific company questions, because it's not right to talk about the company. We don't know many companies. So we'll confine to more about the investing or anything else. I mean, macros, global macros, investing. But please avoid specific company questions. Thank you.
Hello. Hello. Yeah, Raamdeo ji, there's no question from my side. I just wanted to say thank you very much. You have shared your secret to all of us, and that's a very great thing. Thank you.
Hello. Am I audible?
Inflation. We get a very different picture. And I would wish all the graphs that we see of growth and the Nifty becoming 29, today 9,000, or the Sensex becoming 30,000. If we adjust it for the inflation which this country has gone through, wherein, I might share with all the members that in income tax we have a cost inflation index. And if we look at that index, in the last 30 years, the rupee has depreciated more than 10 times. And when we adjust that for the sex movements, the growth phenomena which we see doesn't appear so attractive. What would be your response?
So, good question. I mean, I wish, Praveen, do we have that chart? Inflation, there's a chart. Can you just? So we have this chart, what you're saying. I have for 34 years since BSE Sensex has started, that is 78 onwards. So, what happens is that the compounded inflation is about 8.5%. Okay. So 100 has become, your 100 rupees has become 5.4, I think. The last number I've seen is 5.4. It is 1/18th. So you're absolutely right in what you're saying. And your 3-year rolling SBI deposit rates, that's the only fixed income reference point you have for long period, is exactly 8.5. Sorry, the inflation is 8.25, and 3-year rolling paper is about 8.5. So more or less it is same. So the 100 rupees, if you had given in SBI deposits, it would have become 18 times. And rupee has become 1/18th. So you have gone nowhere inflation adjusted. See, what is investing? Investing is surrendering current purchasing power to gain more purchasing power in the future. Basically, you are saying, I want return inflation adjusted. So by going to the fixed income, you are not gaining in purchasing power. Your purchasing power is intact. What you are buying 100 rupees 34 years back, you will get 100 rupees worth of stuff today also. But if you had gone to stock market, you had bought at 100 rupees the index. Today index is about 50,000 come dividend. What you see 29,000, that's a X dividend. If you accumulate all the dividend of 1.5%, it's about 48, 49,000. So it has become about 50,000. So it's about 500 times nominal. The inflation adjustment will bring it down to 1/18th of that, which will be about, I think, 20 times or so. Inflation adjusted in last 34 years, it will be 20, 25 times of what you had given that time. But during the same period, gold will be about 3 times, fixed income will be 0, 1 to 1. In gold, you will get 1 to 3, and in stocks, you will get about 20 times. That's the difference. Have I made it clear? Yeah. Yes.
Have you figured out a robust way of evaluating quality of management? I know it's subjective, but have you been able to put together an objective parameter and process? Because in your analysis, the Q of management and along with business is paramount.
Yeah. So clearly, these are qualitative things. I mean, we have our checklist. And you get a book on checklist on all the parameters. But you have to keep see, they will give checklist, but how do you apply that checklist is your call. So if somebody is saying that payout has to be fair, they have to be fair to all the stakeholders, government, the employees, the staff, and the shareholders. So when you look at when you look at the application, so what kind of behavior? So first thing I look at for the management is whether they pay full tax or not. Is there any cash dealing? Do they handle the low end of the employees well? High end everybody handles very well. How is the behavior? That's why I want to meet the management in their office, because you can see the behavior there. Are people very scared of the top management? What kind of treatment they've given to the minority shareholders? Have they cheated in the past? So the list goes on, But yes, all these things, they definitely come in our, one is the competence, second is the intelligence, and third is the integrity. So integrity is very important. If the guy is not having impeccable integrity, see, in India you get all the managers which have competence and passion. But competence, passion with integrity, they are very few. And that's where your number of companies, they get reduced big time. Investable population, they get reduced a lot. But I agree that's a very difficult part of the QGLP. Judging quality of management is one of the most difficult one. Yeah. Thanks.
Yeah.
Next.
Hello. How easy or difficult it is to identify, let's say, 100x stocks today versus what it was 30 years back when you started? Secondly, would you agree that markets have become more efficient, especially in India, versus what they were 30 years back?
What was the second question?
Markets have become more efficient versus what they were 30 years back in terms of the pricing.
Yeah, beyond doubt. I mean, that's what I said. I said 80s and 90s. They were primitive. I mean, you could read the balance sheet and go and buy a stock and you could make money. I mean, balance sheet used to come after 15, 20 days of the result, if you're lucky. Read that balance sheet and go and buy the stocks, you make money. Because nobody was reading the balance sheet. There were no guys who bothered about the balance sheet. That was the 80s. Today, you have to go to the boardroom. People are doing trading even ahead of time. Nanoseconds, You want 915. I mean, SEBI is saying that every single information has to be given to you through the BSE, anything worthwhile. So it has become far more efficient. Quarterly results, every single information, every single significant information. You get a big contract, you have to be telling. You buy a big piece of land, you have to be telling BSE. I think there is a massive efficiency. Now coming to your first question, I think it was about you. What was the first question? You said, is it easier to find 100x stocks now? Yeah. So I see you get very few ideas, very few opportunities to see 100x stocks. After this study, I realized that for 100x stocks, we get lots of them. Almost all the 47 companies I would have gone through in one way or other. The problem is we didn't have enough patience. I made a lot of money out of Infosys, but I bought it at about 1,000 rupees, sold it 10,000 rupees. So it was 10x in 2 or 3 years. But it didn't become 5,000x for me, or 1,000x out of that. So the patience part is very, very important. So actually I have lived only one stock which is 100 times for me. That is Honda, Hero Honda, which I bought at 30 rupees and I got paid 1,200 rupees dividend, and today it is like, this kind of price. So you don't get to live actually. So the real challenge is not to find stocks. There will be multiple stocks which will become 1,000 times from here. Because this is exponential economy. When the economy moves from 2 trillion to 3 trillion to 4 trillion to 5 trillion, and it is globalized, the opportunity is no more local, it is global. Where is the big money made? You look at which is your most expensive stock. TCS. This is not an Indian company. They are not catering to Indian consumers. This is the most global company. So the opportunity is global now. So, but then every company starts at 200, 300 crores kind of situation. Look at Sun Pharma. I mean, it has started with less than 1,000 crores kind of market cap, and today it is the largest and most admirable global company. Today there is a merger happening of Mylan and Teva, which is going to give birth to $100 billion. So clearly this space is very opportunity space. Many companies will be born even better than Sun Pharma will come up in this space. But they would be today maybe 500 crores or 1,000 crores. They will become 50,000 crores, 1 lakh crore, 2 lakh crores. When Sun Pharma goes to become 5 lakh crores, these guys will become 50,000, a lakh crore and all. So there are opportunities and many more opportunities. In online, I think it's after 10 years, we'll realize that 2000 is not change of the century. It is change of the era. Pre-internet and post-internet. Internet will redefine a lot of businesses. And you see your life is being run by that. If your smartphone is off for 1 hour, you feel uneasy. Okay?
Hello.
Yeah.
Yeah, hi, Raamdeo.
Hello.
Yeah, I can hear.
Yeah.
Yeah. As you said about internet redefining the whole business landscape, like in retail or in any other businesses. और ये बात भी बहुत सही है कि काफ़ी businesses जो पहले चल रहे थे, growth थी, अब वो because of internet they are not able to cope with the internet companies. So how do you you talked about the QGLP theory, where it's sort of limiting the universe to that QGLP formulae. But it may happen that कि कोई कंपनियां यहाँ से वहाँ चली जाए, वहाँ से कहीं drop हो जाए. So how are you going to sort of balance yourself and exit or enter into various companies, seeing the dynamic scenario?
Yeah, see, one other thing is that, I mean, basically, you don't do what you don't understand. So you don't have, see, we need only 15, 20 stocks. There are 5,000 stocks here. And we don't have to necessarily buy from internet stocks. First thing is there are not many internet stocks listed here. And in any case, I understand very little about internet-based companies, profits and how it will shape up in next 10 years. So it's not a very, very difficult, because you don't have to sweat about something which you don't understand. Let the guys who understand, let them make money. There's so many other stocks. We need only 15, 20 stocks. So for me, it is very clear. You know, I mean, a lot of these new things will keep happening. Today it is internet on retail, something else will happen somewhere else. You don't understand them, so you have to stay away. So for me, it is very, very easy. Yeah.
Yeah.
What do you, when you decide to sell a share, what are the factors you consider before you take that decision?
What is the?
When you're selling a script, what are the factors you consider before you take a decision to sell?
Okay. So as far as this selling is also a very difficult thing to say that this is the perfect way to sell. We have two, three reasons for which we sell. One, if we are wrong. The moment we realize that whatever our thought process about the company is completely wrong, baseless, we'll definitely get out, even at a loss, massive loss. Because if the story is not going to happen our way, we're not going to make money, period. So let's better cut the loss. So like financial technologies, we bought with a lot of conviction, but the moment we realized that we are in the wrong foot, at lowest price I sold, at 155 I sold. I knew nobody is there behind me. After this is the lowest price. Still I said, I don't want to die every day. Let me be done with one day. I sold it and I'm better off now. I use that money to buy something else. But what happens is, that allows you to think afresh about that. Second is, when the companies commit mistake. Say Tisco going to having bought, say, Chorus, or Bharti bought Zen. See, whatever they're thinking might be, they're big guys. We cannot influence their decision, they've already done it. It is for us to give the stamp of disapproval. And the way you do it is, you sell it. In Ranbaxy, when Malvinder sold it, before he got the money, we got the money. So, either we are wrong or they are wrong. Or third is, it is so good that stock has gone 5, 7, 10 times. Your 5%, 6% allocation has become 18%, 20%. You have to cut it. Like L&T in 2007, it became 17%. So we sold half of it. And we brought it down to 8, 9%. And after the market went down, it became 4%. Then we sold very recently Bosch, Aisha, I think Page also. So we trimmed it at the top. So, these are situations where we sell. Pardon? Yes. Yeah, so still whatever we hold, this is the dynamic kind of situation. We have not bought these stocks at some 400, 500 rupees for you. So, one of the ways you create 100 baggers, actually if you go into the study, you go and see the study, it is QGLP. The first requirement is you got to buy small and relatively unknown. Today, it is very large and very well known. FIs are dying to buy into Bosch at 85 P multiple. You have to give some bit of it.
Yeah, Raamdeo, if you...
Where is...
Yeah,
please.
If you spotted a company which is very good business, but the management is questionable. Of course, I remember you've answered that question. In the scheme of this formula of yours of investing, what is the percentage that you would attribute to the questionable management, and to what extent would you be prepared to compromise on that?
That's why I got into FT. I compromised. So 1 multiplied by 0 is 0. If I realize that it's the management, a compromised management, I will not go there only.
There are, there are many companies which are very visible today in the stock market, where the businesses appear to be very great, but even the management is very, very sort of questionable. That is also very visible. But despite that, there are lots of brokerage companies and lots of investors which keep on chasing these kind of companies. How would you personally react in this method of investment of yours?
Yeah. So, of the competence and integrity, If by chance competence, everybody is not at the top. If it is at the medium level, I may still buy it because the business is very good. But if I have a doubt on the integrity of the management, then absolutely non-negotiable. Absolutely non-negotiable. No. I mean, just don't go there. That guy will never be able to deliver you. He will never deliver. He will make money. All the builders are what? Why these builder companies they are making tons of money. All the shareholders are gone pauper because there is nothing in the integrity of the builders. Books are written only in Lonavala. How will you make money? They are making money, we know for sure. If you buy a flat at 40,000 rupees square feet, 50,000 rupees square, obviously they are making money.
But there are managements also which don't pay salaries. Despite that, they have got exponential valuations.
Yeah, so see, in the market you'll find all kinds of companies and there are all kinds of ways of making money. I am saying this is a very narrow 2% way of making money.
What I am saying is, would you avoid them?
Completely. See, out of 5,000 companies, if I want only 15, 20 companies, I have to say no to 4,980 companies. So I have to find reasons also, no? So these are the reasons. Either business is bad, or management is bad, or growth is not there, or there is no longevity of growth, there is only 2 years kahani, or it is very expensive. See, these are the only 4 factors in which 5 factors you have to play. If anything is missing, it is 0.
Thank you.
Yeah. No,
I have a question here.
Let's go one by one.
So have you, in your most recent study, identified the sectors for the next decade or two that you think are going to really outpace what you've seen before?
Can you just speak up? Sectors which are going to?
Outpace the growth that we've seen before.
Yeah. So we said that we gave the framework that all the discretionary spend and companies in that are going to make a lot of money. Now at what stage you buy? Say in banking, you see you're given birth to HDFC Bank, you're given birth to HDFC. There will be a housing finance company because opportunity in a housing finance company today for mortgages is multiple times bigger than what it was in 1980. This is a brown piece of land, this whole country. So, but then, there will be a company which will come up and say that I'm the next HDFC. Or there will be a bank which will say that I'm the next HDFC Bank or better than HDFC Bank. I'll use much more internet and technology than what HDFC is using. So, it can come from anywhere. Like, say, Aisha, like the Royal Enfield motorcycle. 4 years back, nobody bothered about Royal Enfield as a company. Today is most aspirational motorcycle company. So, all this discretionary spend. There are companies you can see some of the services which you would never think that will become big might become 100 times, 200 times bigger. Like broking services, like it's not considered as very large service. But go and see in Hong Kong what is happening to the broking companies. The volume in Hong Kong and Chinese market is like $200 billion a day, cash market. Here we are doing $2-3 billion. We will hit those positions, mind you. So you have to see which companies geared up for doing that, and can you buy those stocks? So there are exponential opportunities because the world is becoming crazily at very rapid pace. Financial markets particularly is becoming literally on the laptop. You don't have to go anywhere. You can sit in any farm with internet connection. You can do what? You see that flash crash today? The US authorities have nabbed one Indian, some Sadarji, who was trading in London, and he caused 10 or 15% decline in the market in US. I was in US at that point of time. It created so much of chaos, and they've tracked him down. It's crazy that one poor chap sitting with $20-30 million, and he caused global chaos. I think the case will not stand against him. But, the authorities, they are blaming him. So one trader sitting in rented premises somewhere outside London, causing global turmoil. That's the power of technology. So if downside can be so massive, upside will be even bigger. And these markets are crazy. See, what is stock market? Stock market is present value of future anticipated profits. What profit will come, only God will know. See, who knows who's going to make how much money? But today, the opinion is that TCS is going to make multiples of 5 lakh crores. See, today I'm buying at 5 lakh crores. So I will not pay 5 lakh crores valuation unless I think that it is going to make at least 10 to 15, 20 lakh crores. Why should you pay? But whether it will make 15 lakh crore profit or 50 lakh crores profit, who knows? So it's about the opinion. So stock market is a crazy system. Somebody thinks that Flipkart is going to make, I mean, if it is 60,000 crores, Nestle is 60,000 crores and Flipkart is also 60,000 crores. So somebody thinks that Flipkart is going to make more money, multiple times more money. They are dying to buy Flipkart shares. In next 10, 15 years, I mean, like, they are going to make some 2-3 lakh crores profit. You go and ask them, they say, we also don't understand the valuation. And I'm not joking. I was with one of these 3-4 guys. They said, we don't understand valuation. We understand our business, we'll make money, but we don't understand the valuation. So I said, this is how we value. Sir, we don't have any clue to this, that how much money we'll make, but we'll make money.
We can take one last question.
Yeah.
And close for the evening. Yeah.
Sir, it's very easy to say for
Yeah, just one sec. Yeah. Please.
it's very easy to say 10x, 100x past 20 years, you know.
Yeah.
But even good businesses go through bad phase of time.
Yes.
And what makes you hold them that time?
Yeah, so the point I said, whether you understand the business, the 99% sweat in investing and analysis is whether you understand. We start valuing things without understanding it. If I say you are a billionaire, because from face you look to be a billionaire, is that fair? It's not fair. I have to get into, I mean, I must sit with you, what is your balance sheet, how much you earn, then only we can figure out whether you are a billionaire or not. But when it comes to valuing a company, you look at P multiple 5 and you say you are very cheap, and somebody is 50P, you say it is very expensive, as if you know everything about them. The biggest crisis of the market is that everybody knows the price and valuation without knowing the underlying values. The process is to know the values first, then do the valuation. You'll be in much better shape.
In your formula of investing, how much credence do you give to political stability or instability?
See, these are important, but we can do nothing about it. So it doesn't matter much. Yeah, every day morning it's a new news. Go and listen to, if you are frustrated, go and listen to 9 o'clock show. What is that called? What is the Times of India? Arnab Goswami. I think he'll set you right. So, as far as investing is concerned, these things will keep happening. Someday somebody will commit suicide, some banker will commit suicide, so it doesn't really matter. Even, see, eventually this is very important. What kind of leadership? So what excites today? After 30, 40 years, you've got a leader who wants to die for this nation and die for the development of this nation. Not as a patriotism, just like that. I'm a Hindu, so I want to die for this nation. No. He wants to die, he wants to dedicate to uplift the whole nation and become a global leader in the process. You don't get, this is like Narayan Murthy in Infosys. You don't get this. I don't know, this country is crazy. I mean, even leaders can perform only if somebody follows. It is a time to give him opportunity. And in 10 years, see, in 10 years in Infosys, you made it 1,000 times, 2,000 times. That's the opportunity for India. If Modi really happens, see, if right now Modi has not happened. So that's why this valuation and this skepticism. But जिस दिन होगा, मोदी का चरखा चलेगा, आप देखना फिर.